Hi, fools. So, we often hear that, that the financial game is rigged, but my guests today argue that the system is literally fixed, designed to work against the neglected middle through high fees, complexity, and unequal access. But as technology and AI reshapes lending, insurance, and investing, are we about to break the system further or finally fix it for good? So let's welcome Professors John Campbell and Tharun Ramadharai, authors of the new book, Fixed, Why Personal Finance is Broken and How to Make It Work for Everyone. Thanks for joining us today.
Thank you. Great to be here.
Yeah,
Thanks.
so
Likewise.
so I want to kind of set things up. You open the book with a powerful kind of double meaning. The system is fixed, as in broken, but also fixed as in rigged. Working to the advantage of the operators. You identify the neglected middle as the primary victims. So why is this specific demographic, middle class households and emerging and developed economies, bearing the brunt of this inequality compared to the unbanked or the ultra wealthy?
Um, shall I take that one, John, to begin with? Great. So I think the way to think about this is that there's a lot of interest, and justifiably so, on the very poor. And there's also a lot of attention, perhaps vicarious attention, paid to the very rich. And our contention is that there's this very large slice in the middle of those two extremes, which has been a little bit understudied in academic work, but also these are the people who are primarily, the taxpayers that we all think about. Of course, everybody pays taxes, but or at least we'd like to think everybody pays taxes. But these are people who are very important also for electoral purposes, for lots of political reasons, and so on and so forth. But I think more importantly, especially when it comes to emerging markets and other places, these are people in many cases who have just about acquired the resources to come and participate in the formal financial system for the first time. So they have very little knowledge, which can be quite dangerous. They're entering a predatory environment, which is also quite dangerous, and sometimes they're very unaware of that. And so that's kind of one reason why we think that they're very important. But the second reason that we think they're very important is that these are their first encounters with the financial system. And as we all know, those first impressions can be extremely important to the way that they proceed through their lives, and they can very quickly lose trust in finance and jeopardize the whole project of finance, which we think is very important for modern economies to function.
I know you said that one thing that was interesting that you said that I didn't ever think about it this way is that sometimes you have the wealthier that are almost being advantaged by the lower income or the people that don't have as much knowledge. And in fact, it's almost like they're being subsidized. Can you talk a little bit more about that? Because that's not something I think that is really well known.
Yes, that's an important theme in our book, Sanmeet. It's something that really is underappreciated. The fact that your good deal may be someone else's bad deal and may in fact be funded by somebody else's bad deal. This is something that's emerged from academic research over the past 20 years, and we've discovered this process going on in place after place, product after product, right across the financial industry. And what happens is this, you have financial products that require careful management. People have to watch out and not pay unnecessary fees. So for example, if you have a bank account with so-called overdraft protection, you need to make sure you don't use your debit card multiple times on the same day with an overdraft, or you're going to be charged $35 every time by the bank. Or if you have a credit card, you've got to remember to pay by the due date, or they'll slap you with a late fee, even if you're only a day late. If you have a fixed rate mortgage, you have to remember to refinance it. If you have an adjustable rate mortgage in the UK, where they all have teaser rates for the first year, you need to know to refinance that one as well after a year or two to keep the teaser rate. If you have a life insurance policy, you need to remember to pay the premiums so you don't lapse. Now, the fact is that many people mess this up. They make mistakes. They forget to do the right thing, and they create revenue for the people selling the products, the firms selling the products. Now, that may boost firm profits, but there is competition in the financial industry. People are competing for customers. So what happens is that the firms pass some of this on in the form of lower upfront prices. So we all get free checking, in part paid for by late fees. We get credit card rewards, in part paid for by credit card late fees. Mortgage rates are lower because of that revenue that's coming in from the people who don't refinance, and insurance premiums are also lower. So this is going on all over the place, and we think one should not take this for granted. This is really a very bad thing. It's robbing the poor to help the rich, really.
Yeah, it's like just to open up bank accounts or brokerage accounts or savings accounts or all these things that you mentioned about, fixed costs of opening accounts, fixed costs of originating a loan, just engaging in the financial system itself. So I guess the main point, and you mentioned how, the three ways in which finance kind of drives inequality is, the rich people are earning higher average returns on their savings, they're borrowing more cheaply, they're saving more. But then, the lower income people don't have as much advantage because of the way the system is going. So I just wanted to kind of make sure our listeners understand the kind of the core thesis of how you're defining the system as being fixed.
Yes, some of these issues that disadvantage poorer people are actually inevitable. I mean, there are fixed costs of providing financial services. So that will mean that a small account, a person trying to get a small loan or open a small checking account, is likely to pay more proportionally just because of those fixed costs. Now, the technology is helping there. Technology is lowering fixed costs. But what we say is, let's at least squeeze out these other subsidies that flow from poorer people to richer people.
Yeah. Now, the problem is definitely vast and huge because the financial system is something we all use. One of your other main compelling points is, human intuition is just terrible in finance. We rely on personal experience rather than long-term history. You mentioned, this was really interesting, reinforcement learning happens dangerously slow in finance. We have to wait 40 years to understand if our investments or our financial strategies are actually working out. That feedback loop is so long, So how do we kind of bridge that gap between our Stone Age brains and this complex modern market?
Yeah, I mean, this is absolutely a problem, which is in some ways we're wired to potentially spot threats. And so there's a part of our human biology that is, sort of working for us in those kinds of situations. Now, the good news is that we have the rational capacity to do long-term calculations. And, we can factor in uncertainty, and there's plenty of guidance for how to do this. And, academic finance is all about kind of the best way to make some of these very complicated decisions. The trouble is, of course, that some of those decisions are so complicated that the average person has very little time to engage in those kinds of calculations. When they make a decision today, sometimes the outcomes can be many years in the future, like a pension or retirement savings decision today is going to only kick in when you're 65 years old, or, at the point of retirement. And then of course, because of the power of compounding, small errors can really accumulate over a long period of time. So when you sort of put all of that stuff together, and the stakes are so high, that people will sometimes just simply avoid these problems because these are difficult calculations to make. They require you taking time out of your day-to-day to actually do this. And of course, the Motley Fool is kind of partly in response to issues like this. But, even if people finally get to the point at which they have to make the decision, we argue in our book that these decisions are, first of all, intermittent because people put them off for very long periods of time rather than incur the mental cognitive cost to engage in these complex calculations. But when they finally get around to it, rather than taking the cold, calm, rational decision that you have to, what they will sometimes do is just get very emotional because they get overwhelmed by the scale of the decision. They've let the problem build up over a long period of time. And so intermittent and emotional is sort of a sad, but we think efficient way to characterize the way that most people make financial decisions.
Yeah, I mean, it's a scary world, even for those that are literate in finance and with the complex products and the services out there. You mentioned a lot in your book too. You know, financial illiteracy is a massive contributor to lower returns, and I'm going to challenge you both a little bit here. Now, I'd love to hear from both of you. You know, if high schools are increasingly offering financial literacy courses, college as well. In fact, my kids in middle school and my son in middle school and even my daughter in high school are actually learning more finance than I ever learned when I was young. So that's great. But why aren't we seeing better outcomes? You know, you already mentioned that education is, not the only answer, but are our brains just not wired for this? Compounding is a very powerful concept, but it's sometimes hard to grasp. So where's the disconnect?
So we're big fans of financial literacy education. We're involved in it directly. I teach a personal finance course at Harvard that has over 300 students this fall. We applaud the spread of financial education mandates in the United States. More and more states are requiring this in high school. This is all good. But the way I think of it, it's a race between financial education and complexity of the system. Mm-hmm. And complexity has been winning the race. And we think we need to slow down the complexity to give people a chance to catch up. And I think one also should have realistic expectations about what education in high school is going to achieve, because the problem is that high school students are not yet making most of the big financial decisions. They may be taking out a student loan for college. They may be getting a credit card, but they're not taking out a mortgage. They're not thinking about saving for retirement yet. They're not buying life insurance. And so a lot of the financial education topics may seem rather abstract to them. Mm-hmm. Just imagine if driver's ed only had the classroom component, with no actual road driving experience. How much would high school kids learn about driving? Probably not very much. So we think that we certainly should work hard on financial education, but we should be realistic and not expect this to solve all the problems of the system.
If I could just add to that,
yeah.
I think one of the things that is important to recognize is that, I was sort of just thinking about this the other day, which is even I, as a finance professor who's spending most of my life doing this, what fraction of my day-to-day do I spend thinking about my personal financial decisions? Mm-hmm. Relative to all of the other concerns that I have. Now, on the other side, which is the suppliers of financial products, what are they doing all day? They're trying to figure out exactly how to work on selling me products. And so in some sense, the game is, I could get as educated as I need to be and spend all of my time doing this, but it's just not a very fair contest between kind of David on the one hand and Goliath. I mean, my slingshot may be terrific, but there's this giant in front of me.
Yeah.
And it just feels like we're kind of asking people to get really educated about something that people have very strong incentives to do on an industrial scale. And I think that's all for the good. We love the way that capitalism focuses our energies on these things. I guess what we're saying is we need those bits of capitalism to function in a way that's delivering the very best outcomes for us as financial consumers.
Yeah. It's a great pivot because while we talked about how the consumer has its struggles, the financial system knows these things like how emotional people can get, how much we don't think about our money. Even the educated that have some understanding, you may not. I think some of the worst personal finance people are people that are actually in the profession of finance. It's almost like doctors are the worst patients, right? So it's similar in the finance realm. But how does the financial industry kind of use that knowledge of how consumers behave and act and their mindset. And what's like a concrete example of like maybe a product or service that kind of exploits that? John, I'll kick it to you
Well,
first.
you know, we start our book with some horror stories of financial products that have worked out very badly for people. And a couple of the stories have to do with bundling, which is where you combine what are essentially different products and you make them into a complicated compound product, if you like, that smushes it all together. And this has two effects. It's easy for people not to appreciate the traps within the product, and it's also very hard for people to figure out how expensive it is. So these things can easily be missold and pushed on people. And you know, we have one story from the UK about a man in his early 60s with recurrent health problems who was sold what's called payment protection insurance on, you know, mortgage and other debt. And he had to pay very high premiums on this. But, you know, the irony was that actually he would never have been able to collect on the insurance because he had a pre-existing health condition. So he was paying for something that was completely useless, and only discovered this after many years. Then we have another bundling example from India where insurance and investment product were bundled, and essentially the client lost all of his money through a combination of poor investment returns, but mostly exorbitant insurance premiums that were part of this very confusing package.
I can jump in here with another sort of classic example, which is that often people are sold extremely complicated derivative products, which actually sort of on the face of it seem very easy to sell, which is to say, you know, I've got there's these wonderful stocks out there. You may be interested in investing in AI. We're going to be able to give you the best 3 AI performing stocks and we'll cap your downside. But of course, if the price goes above a certain limit, then, you know, you're just going to get protected, but at the same time, you will be capped on the upside. Essentially what these kinds of products are, which might seem very appealing to people, and in some cases can be helpful at inducing them to invest in the first place, is that they're just packed with hidden fees because derivatives are expensive. And, you know, all of those premiums are bundled into these kinds of very complicated structured products that sound terrific because it sounds like you're getting all the upside and you're not really participating in the downside. And that's true, but it comes at a price and people don't really understand the price very often. So one has to be a little cautious, right? I mean, it's the age-old thing, which is that, you know, you don't want to be part of a club that admits you immediately for membership. And so there's many types of cases of these kinds of products out there.
I think what these products do is they make it very hard for people to shop on the basis of quality and price. And the classic argument for capitalism is based on competition delivering good quality at low prices. But that's only going to work if people are able to shop with an awareness of prices and an awareness of quality. And so the more these products conceal fees and conceal risks, the less well capitalism works. So we actually have a chapter in the book called The Corruption of Capitalism, which describes how this happens in personal finance.
So one of the chapters that I found very fascinating that you talked about and kind of segues into kind of my next kind of area that I want to discuss is, you know, we have fintech and now AI, which is kind of incorporated with fintech. You know, is this the savior or is this the villain? You know, is you know, you talk about, you know, you have a chapter titled "The Promise and Peril of Technology." While technology, I guess I'm reminded of the Spider-Man quote: "With great power comes great responsibility." Right? So, technology and AI is just like that. You know, there's so much potential for it to help do what you're proposing to fix this system, but it also has some perils. So let's talk a little bit about kind of the benefits of fintech. What can it do to assist people with their personal finances?
John, do you want to go on the benefits and I can jump in on the risks?
Yeah,
sure. All right. Yeah. So I mean, the first thing that fintech does is it lowers the fixed costs of providing small ticket items, small loans, small accounts, small insurance policies. So there's very clearly a good cost reduction benefit there. Related to that, fintech makes it easier to customize products to meet people's preferences, and it can be used to make search easier. You can, get different insurance quotes, for example, for annuities or other insurance products on a smartphone. So it's sort of an easy interface for shopping. So there's a lot of promise there, a lot of benefits. AI, of course, is the new kid on the block. Is the smart chatbot. And it can provide customized financial education if you know how to use it and how to ask the right questions, and that's of course a very big if. So those are the benefits, and we are genuinely excited about them, and try to provide a very balanced view of what technology can do.
And Tarun, you're going to mention the risks.
Yeah, I mean, yet again, I think the question is, I think you're right about with great power comes great responsibility. And so, I think sort of going back to our previous discussion, which is that it is often the case that, obviously what we would love from capitalism is to give you the highest possible quality at the lowest possible price. And in finance, if we sort of take what you started off with and a great question about, well, why is our biology sort of working against us in these kinds of calculations? It's not clear that we are making the right decisions and that we are demanding the things that we need. We're sort of demanding the things that we want and what we need can be two quite different things. Now, the thing about technology is that it can be simply used to feed these desires that are not the desires that we want it to feed. So just to give you an example, I was just chatting with my wife yesterday, and we were talking about how often one is tempted to pick up the smartphone. Mm-hmm. And it's a sort of digital addiction. It is a tool that delivers enormous benefits. But on the other hand, people are basically incentivized on the technology side to produce things that just keep us, constantly going for the catnip as much as we possibly can. And that's a pretty damaging consequence of the technology that is being used. And so very similarly in finance, what can happen is, and I can give you a couple of examples of this, that you could, without regulation, have a chatbot that is pointing you in the wrong direction to products that have very high embedded fees, to commissions that you're, again, hiding, which are sort of financing the revenues, rather than things that are actually, low price, high quality products. So there's a sort of weaponization there. But of course, there's other consequences as well. You could get algorithmic discrimination if you're not careful. We've done some work about that, and we refer to this in the book as well, which is, you have these enormous models that are very, very good at sort of picking out where the credit risks are. But if you're not careful, what they might end up doing is de-anonymizing certain groups of people, even though that is strictly legally forbidden to do. And then you kind of do an end run around the regulation that way. And then, of course, another culprit is potentially decentralized finance, which on the one hand can be very effective at maybe sort of implementing contracts and doing things in an automated fashion in a transparent, publicly available way. But on the other hand, can generate things like cryptocurrencies, which are, in many cases associated with scams, have very high and volatile returns that people don't really understand very well, potentially have code that is impenetrable to anybody but the creator of that original code. So there's lots of reasons why you might worry that, when Prometheus brings fire down from the mountain, it's not necessarily the case that it's only going to be used to cook food. And so we have to be a little careful about that.
Yeah. You talked a lot of the big areas in finance in terms of spending is like, you have housing, college, and retirement. And those are, I would say the biggest decisions, the financial decisions that we make, and you know, it's a challenge to pick the right products and services that you need in each of those areas. But now, when you have kind of tech and AI incorporated, you have these companies that are, working to hopefully assist the consumer with that. So, we like to look at a lot of companies here at the Motley Fool and our members. So, as I kind of think through those buckets, something like an upstart, for example, they are using AI to kind of use non-traditional variables to prove invisible prime borrows. You see these AI lenders, and then you also have the ones that do upstart will do various different loans. You have mortgage ones. Any of these lenders, student SoFi and the student lenders, do you see them as kind of genuinely leveling the playing field, or are we just kind of wrapping like the same old risk metrics into like a shiny new algorithm? John, I'll let you start off with that one.
I think it depends honestly on whether the AI has data and can process data that was previously unavailable. I mean, it's certainly true that if lenders, using AI or not, have access to information that was previously missing, such as, for example, very regularly making your rent payments, that has not historically been available, or looking at the composition of your spending. And I know there are some apps that you use as a payment app, but then by observing what you spend money on, they can more accurately predict your credit risk. So I think these are innovations that have some potential, undoubtedly. At the same time, a lot of this is spin. Every company has the incentive right now to put AI in their name or in their marketing materials and say it's driven by AI, and very often that doesn't mean that much at this point.
Yeah, I mean, I would sort of add two things to that. Now, let's take the simple example of using an AI algorithm to deliver you credit based on non-traditional variables, right? Now, one good telling of this story is that they're basically cream skimming. They're going into a segment of the market where people have avoided it, and what you're actually doing is potentially just getting people who are actually great risks to take, but have been kind of pooled with the other group of people, and that is great. And in some cases, that can legitimately happen. I think we saw that with Capital One. This was the only place that would give me a student credit card. I mean, a credit card as a student, and as it so happens, I've turned out to justify their faith in me by being a good credit risk all these years later. But the other thing that you worry about is that there's also a profit maximization incentive that's going on in the background, which is to say, one telling of the story is I give you credit and you repay me and everything's great. The other telling of the story is I give you whatever you want, but I'm just trying to look at you as a place that I can suck as much money out of as I possibly can, whether that comes in the form of late fees, whether that comes in the form of staggered repayments, whether that comes in the form of you getting into a debt trap and sort of, your lifetime value is still very high to me. And so we might worry a little bit about the fact that the technology needs to be restricted to going after the attributes that are not just lifetime customer value, which could come like a vampire by sucking someone's blood, right? As opposed to being in a situation where you're only picking the best risks. So we have to be a little careful about that.
I think the key thing is that AI is very capable of detecting who's not good at searching, who's naive, who's going to take a bad offer. And we know that kind of price discrimination is going on more and more with online shopping of all kinds, whether it's, travel or, just retail products. And it can be very damaging in the financial industry if those practices spread.
Yeah, absolutely. It's almost like if AI can be used to assist consumers in making decisions and finding solutions versus AI being used to just create products and tailor things to customers that might just add to the complexity. So one of the other bigger areas is retirement. We with retirement you have the issues of am I saving enough, how to save, where to save, things like that. So you mentioned in your book the annuity puzzle. Economically, buying an income stream for life makes sense, to solve the problem of uncertain lifespans. But people hate buying them? Is this just kind of because of the substantial markups you mentioned, or is it like a psychological hurdle to handing over a lump sum that the industry hasn't figured out how to jump?
Yeah, I think it's a combination of things because because of this. Start with the reluctance. Yes, people are reluctant to hand over their money, and I think they often think of annuities the wrong way as investments that are risky as opposed to insurance products. What that means is, marketing costs are high for annuities, and then there's adverse selection. The people who tend to buy them are the people who may know that they're likely to have a long lifespan. And you get a sort of vicious circle where the market is small, the product is expensive, you get this adverse selection. In the book, one of the things we say is that we think deferred payout annuities are a good product that should be more developed, because that's a way of really ensuring the catastrophic risk that you're going to live way, way, way longer than your resources allow. And it's true, you have to pay money up front and then nothing is going to happen for many years, but you have to think of it as a form of catastrophe insurance, where the catastrophe in this case is, wonderful medical news, but that is very bad financial news, that you live to a really quite unusual old age.
Yeah, I mean, let me just sort of jump in here and say, I think this is kind of exposing a deeper problem, which is that people really find insurance quite difficult because it feels a lot like paying something to get nothing. And that is true. In the best case scenario, the risks don't materialize and you've kind of given away a bunch of money. But I think what people don't really get about insurance is that the value of insurance kicks in at bad times. This is doubly difficult, as John's just said, with annuities, because it's very hard to think about living very long as a risk. And actually that's really what's going on here. It's not, most people are always focused on the fact that, oh no, I'm going to die and all my money will be given to the insurance company. But what they should be really worried about is the possibility of living in poverty, which is what could happen when you're extremely old and you've outlived your financial resources. And in some ways, this is such a hard message to convey that people are just unable to sort of really understand this.
Mm-hmm. So I want to kind of shift to like the solutions, because, not only do you talk about in your book, the problem and then, challenges and risks and opportunities, but you have a pretty clear like plan of what to do to help fix the financial system. And first thing that I would love to hear more about is, you talk about shoving. Well, in fact, chapter 9 is called Shove. And you talk about shoving. So what is shoving, and how is it, why do you propose that as a way to kind of go about things?
Well, the shove, of course, is a metaphor, but we use the word to contrast with nudge, which is the famous approach popularized by Cass Sunstein and Richard Thaler and put into practice by many governments around the world, which is just to make, in effect, a suggestion, or at most a default choice, that many people have this now in their 401ks. Their employer will default them into the retirement plan with a given contribution rate and a given asset allocation. But it's very easy to opt out and change if you want. So it's a light touch intervention that has minimal side effects, because anybody who doesn't like it can opt out. And the early results on nudge were very promising. You could get people to sign up for retirement plans doing this quite effectively. The problem is that as we've studied this more over longer periods of time, the effects wear off. So nudges are actually not that great for increasing the wealth that people have to fund their retirement. You get people to sign up for a 401k initially, but then over time, maybe they change jobs, they pull their money out. Other people who weren't nudged sort of start saving a little later and catch up. And so we argue that nudges have basically failed. The medicine is too weak. It's safe, no side effects, but also doesn't do much. So by shove, what we mean is the government coming in and regulating in a more serious, or if you like, heavy-handed way to to raise the prices of bad products, perhaps subsidize good products, put up barriers for the use of dangerous products, and really try to focus on providing a suite of simple, easy to use, and easy to shop for products that will just make it much easier for ordinary people to get started in personal finance and to shop on the basis of price and quality.
Let me sort of kind of see if I can set the stage a little bit as well, which is to say, I think when people first confront these proposals that we're making, their immediate reaction is to worry about the fact that, oh no, you're threatening to introduce more regulation into the financial sector. That just seems like you're just adding more gunk, and how can it possibly be better? And I think there's two things I want to confront there. The first is there's this kind of intuition that people have that if you introduce regulation, you're somehow going to forego this wonderful innovation that's out there somewhere that is going to make everybody's lives better. And if you constantly regulate, how are you possibly going to get the wonderful outcome of capitalism? And I think the response to that is there are some areas that are so critical for the functioning of our lives and our economies that we're quite happy with the type of innovation that is process innovation rather than crazy product innovation. I'll give you two examples. Civil aviation is one example. We don't necessarily want people to be out there, in fantastic things that have, a 1 in 10 chance of going kablam. Okay, that's just not something that we've decided as a society we want. And utilities is another thing. We want to keep the lights on. We are happy to have them heavily regulated. We're okay to have sort of basic piping of water to our houses or electricity to our houses operate in a certain way. And I think what John and I are trying to say in the book is that finance, personal finance in particular, has very large sections that are kind of like that, where what you want is you want to set firm guardrails. We're very much in favor of capitalism. We want the private sector to innovate. We want the private sector to provide low price, high quality products, but you kind of have to set some guardrails, some pretty muscular regulatory guardrails, within which the financial sector can innovate as much as it wants to, much like you need to put down some rails before you let the high-speed train kind of go do its thing. You need all the safety boxes to be checked. You need all of that stuff to work well, and then off we go. And I think that sort of, hopefully explains the fact that we're not just here, typical academics telling us, hey, let's just regulate people a little bit more. We're saying let's put some rails around this and then let the private sector go do the thing that it's best at doing.
Yeah, like, for example, you had mentioned that's one of the specific examples you mentioned. It's highly desirable to have kind of a single agency with broad responsibility over personal finance. I mean, while we do have sort of that with the Consumer Finance and Protection Bureau, we also have some others that are involved as well, and so it gets a little difficult to really have the consumer's best interests in mind. What are some other examples of kind of like what you're talking about that will put on these guardrails but not stifle innovation?
Well, we think the key is for the regulatory agency to do the hard work of thinking, what does a good, simple product look like? And then to mandate that financial firms active in each segment of the industry must provide that product. Now, the regulation should specify the units in which prices are quoted so that people know how to shop. But we're not talking about regulating the level of prices. We want competition to work there. The vision is that shopping for a basic product should be as easy as going into the pharmacy when you have a headache, going to the painkiller shelf. You see the ibuprofen, there's the brand name, and there's the generic right next to it. You know the active ingredients are the same. You know the dosage is the same. The little price tag on the shelf tells you exactly what the price is. And then you pick your bottle of painkillers. And we want a set of products that work like that. Now, what might be an example? We think that a big problem in this country is the profusion of tax-favored retirement accounts. We have 401ks, we have IRAs, we have traditional, we have Roth, we have 403b, we have 429, able accounts, Trump accounts. It keeps, the list goes on. And the problem is that profusion can lead to confusion. And yet, with all of that availability, many people, particularly those who work for smaller firms or are self-employed, don't have easy access to retirement saving product. So what we think is there should be a single standardized product, probably along the lines of a Roth 401k, that you should open on your date of first employment and then be able to carry with you across jobs. This is actually quite similar to the system they have in place in Australia, which has been working very well. And the vision is similar to what we have with 401ks in this country, but the execution is much better. And it's just much simpler for people to use to get started on their retirement saving.
I mean, another example that one might provide, and which we talk about in the book, is that, we're all big fans of the fact that our checking accounts seem to be free. When you think about it a little bit, they're not free. What's actually going on is that they don't bear any interest. And so essentially the foregone interest that you're giving up is the cost of that account. That's not very transparent, and that cost can fluctuate pretty dramatically. When interest rates are really high, you're paying a very high cost. When interest rates are very low, you're not paying a very high cost. This is also not very good for the private sector because they have to manage the fact that these implicit fees are kind of going up and down in the background. So one of our proposals is that, you should make all of those fees explicit. You should have the usual rate of interest paid on balances in checking accounts, and you should have potentially a fixed fee. I know people don't like fixed fees, but a fixed, open, transparent fee that people can compete on is far better than having some hidden fee that's sort of lying around in the background. I mean, just because, it's not as though when you close your eyes, the world goes away. And so similarly, you have to be very clear about the fact that this is what people are being charged. And I think it's some of those kinds of things that we say we could just clean up and declutter a little bit and then get the private sector to focus on competing on what it's best at. Far better than any other way of organizing these markets. And so that's another example.
So, in your last chapter of the book, you talk about, a better financial system, should have 4 principles, simple, cheap, safe, and easy. And then you also went on to describe, a starter kit for finance as so. Walk me through. I'm a new person in the financial system, and I get my own starter kit. I'm going to open it up. What do I get in there?
Okay, well, you get a transaction account, a checking account of the sort that Tarun just described with transparent fees. You get a savings account, which is similarly transparent, that will make it easy for you to start building up an emergency fund. When you start work, you get a single retirement account, probably with a Roth structure of the sort that I was just describing. You may also get access to short-term credit, probably something along the lines of paycheck advance, which is more and more common these days. We argue that credit should be linked to your ability to pay, not to your desire to spend. So we are opposed to buy now, pay later credit, but we're in favor of paycheck advance. If you go to college, we think you get an educational loan of the type that exists already in this country, but we think that you should be defaulted automatically into an income contingent repayment plan. At the moment, you have to call up your servicer and ask to be transferred into that, and it's very complicated. They don't make it easy, but that should just be the default because it so much lowers the risks to students. When it comes time to buy a house, we think that we don't have a strong view on whether fixed or adjustable mortgages are better, but where we have a strong view is that the pricing should be simple. So no points. Points are deeply confusing aspect of the U.S. mortgage system,
Absolutely.
and no teaser rates. If you get an adjustable rate mortgage, it has a standard rate that resets, and that's it. Then in insurance policies, we don't really tackle health insurance because that's so different across different countries, and it would be a whole book in itself on health insurance. But we argue that it's important for the government to both require and possibly subsidize catastrophe insurance, which is ever more important as natural disasters impinge. We think that life insurance should be restructured to reduce the lapsing problem, essentially by having a premium path that increases gradually rather than being completely flat. And then for retirement, I already mentioned the single retirement account. But when you reach retirement, you need to think about annuities. We discussed that earlier. And finally, we want to have a mechanism for extracting home equity for seniors. So we think that a simplified, standardized reverse mortgage is actually a very good product that should be developed. So that's my very quick overview. Obviously, there's many more details in the book, but that's the kind of thing we mean when we talk about the starter kit.
Yeah. So, I mean, essentially, if I think John summarized this very, very well. It's essentially saying now you're equipped for all of the big decisions that you're going to have to make, and it follows you through the life cycle, and it kind of takes away a lot of the cluds so you can get on with the stuff that you want to do with your life rather than have to spend all your time worrying about the fact that you're getting ripped off in one way or another. And, now you've set up this system. Now, of course, no problem with more complicated financial products that people want, but the idea is that when you get onto the field of life, as it were, you have this starter kit that's going to be there with you. If you want to get more complicated stuff, you can, test into it, get paid, or pay for it, or have something that's customized to your specific circumstances. But there are some of these things that you should be mandatorily offered, and in some cases, they should have some things that are mandatory to choose, because if you don't have retirement savings, it imposes problems on all of the other taxpayers that are on the hook to essentially take care of you at those points in time. So I mean, it's all fairly simple, and it seems like the kind of thing where you could then get, once you've specified these basic templates, the financial sector to compete at delivering those things at the lowest possible cost at the highest possible quality.
Mm-hmm. Now, as you know, as Motley Fool, we're stock pickers, so that's the thing that we recommend to our members, and our listeners are often very eager and excited about picking stocks. In your starter kit, it includes kind of mandatory index funds to kind of keep things cheap and safe. And we tell members and all the time, if you're not inclined to invest in stocks individually, invest in the index and let it ride. You'll do fine, because it does take some time and effort to research and buy individual stocks. So what is kind of the role in your starter kit, or even how you see it, for stock picking in ways that offer some of that higher risk adjusted returns to kind of meet their financial goals?
Well, we think stock picking is one of many financial activities that people are perfectly entitled to do, and some may succeed in doing. But we don't think that individual stocks belong in the starter kit per se, because there's just too much risk that naive people, certainly not Motley Fool viewers, but naive people will forego too much diversification and fall into a simple error. I mean, we start the book with the very sad story of a retired Enron employee who had all his retirement savings in Enron, having worked for the company for many years. He thought he knew the company, was taken completely by surprise when it went bust, and ended up having to go back to work mowing lawns in order to make ends meet in retirement. And we think there's just too much risk of people making that kind of mistake. again, it's not that we're opposed to, Motley Fool or what Motley Fool viewers are doing, but we think this should be on top of a foundation of index investing.
Yeah, having that foundation and setting yourself first, and that's what we always espouse with stock picking. And if you're gonna go there, have your house in order first. Start something like the starter kit. Have your starter kit done and ready and set, and then if you have the resources and the inclination, then you can continue to kind of go forward with that. So
Yeah, I mean, I would just add one other thing to that, which is that, we really like target date funds, for example, which is where your asset allocation shifts depending on your age. But what we also say is that can be augmented, because if you've accumulated a certain amount of wealth already, then you should probably move your asset allocation into wealth preservation rather than further wealth accumulation mode. So there are some sort of broader lessons in there for the design of things that are slightly more complicated in terms of they're not just basic index funds. They're, index funds where the asset allocation is shifting with a couple of different variables. And that also offers some lessons, I think. Even if you're sort of doing it yourself, you should be having these considerations at the back of your mind, which are sort of really important finance 101 considerations, the way that we think about it at this point. We'd love to build those into the starter kit, and we'd like that to be the bedrock of one's portfolio. But, even if you're sort of doing it yourself, hopefully there are enough lessons in the book for the kinds of bigger, broad principles that you should be keeping in mind.
Yeah, and then the book has lots of great stuff in there. And as I kind of wrap up here, I wanted to ask you, for our listeners who's kind of ready to take control of their finances now, if they could do one thing this afternoon, fix their own financial life, whether it's checking a fee, opening an account, automating a decision, what should it be? Each of you, I guess, I'd love to hear.
Well, it depends a little bit on which time in their life your listeners are. I mean, when I'm talking to my students at Harvard, I say, before anything else, make sure you build up at least 3 months, preferably 6 months, liquid emergency fund, and make sure you open a Roth IRA. Those are the two things that I say, basically. That's advice for young people, but of course, many of your listeners will be, at a very different time in their lives where they've already taken care of that.
Yeah, I mean, I would basically say that the biggest decisions are the ones that you want to pay the most attention to. So, and there, rather than talking about assets as John has just talked about, I will talk about liabilities, just given the fact that, so the mortgage is sort of the biggest thing that you have. So you should be, very, very careful about picking a mortgage where you shop for it. You make sure that you're getting the lowest possible price you can get for the mortgage in the first instance, because even those 50, 100 basis point differentials can really add up. Again, the power of compounding is going to really hit you hard if you're not careful about that. And you should refinance when interest rates are falling. I mean, you should really try to get out there and re-ratchet your mortgage and get a rate that's the right one for you. Now, of course, you don't want to do that too quickly because there's some fixed cost incurred to doing that. But, as a rule of thumb, if the mortgage rate out there in the market is a little over 100 basis points or 125 basis points from where you are right now, you should be looking at it pretty carefully.
Mm-hmm.
So that principle of shopping around is perhaps the most basic thing. And, when people trade stocks, we kind of get used to the protection that comes from the national best bid and offer. You're going to put in your market order, you're going to get the market price. But the truth is, most personal finance is not like that. There is no market price.
Yeah.
And that's why you have to shop.
Mm-hmm. Well, the book is Fixed: Why Personal Finance is Broken and How to Make It Work for Everyone. It's a sobering look at the math working against us, but a hopeful roadmap, for how we can kind of rewrite the rules. So thank you both for joining me here today, and thanks for this wonderful book.
Thank you very much.
Thank you. Real pleasure. Thanks.